ahead. I hope you're all keeping safe and well in these uncertain times. My name is Abdulkader Ben Brahim, and I'm the program coordinator of the Making Finance Work for Africa partnership. We're very pleased to be hosting this webinar with our partners from the African Development Bank and Afreximbank, and present this third installment of the Trade Finance Report. We have an excellent group of speakers with us today, and I believe we have more than 100 or so participants registered, and more to come in to register. Will be registering on time. We also have a good mix of representatives from central banks, DFIs, multilaterals, and other industry practitioners. So there's a clear indication of strong interest in this new trade finance report, as is really the case each time these reports are released. So for the outline of today's session, if you can have the next slide, please. So I will first quickly run through some housekeeping items. I will then introduce you to Mr. Stefan Alitembi, who is the Director of the Financial Sector Development Department at the African Development Bank, who will give the opening remarks. I will then give the floor to Mr. Eugene Bempong Nyantaki, who is the Chief Research Economist at the African Development Bank, to present the Trade Finance Report. Following that, we'll move on to our panel discussion segment, which will be moderated by our colleague, Ms. Lola Amusu, who is the Principal Research Economist at the African Development Bank. We will then move to the Q&A session and give an opportunity to our audience to ask questions to our speakers. And finally, Dr. Hippolyte Fofak, who is the Chief Economist from Afreximbank, will give his concluding remarks, and I will wrap up the session. So the session will last about an hour and a half, and we'll try to stick to this timing. So very quickly on the housekeeping items, all microphones will be muted automatically. If you can have the next slide, please. So all microphones will be muted automatically to ensure the highest quality experience throughout the webinar. You can submit your questions using either the chat feature or the Q&A box, and in my screen they appear at the bottom right-hand side of the Zoom window. So we invite you to please submit your questions anytime during the webinar, and we'll make sure that our moderator will address them during the Q&A session. And to ensure the questions are seen by the moderator, please make sure you select all participants from the drop-down menu. Just to let you know also, the webinar is being recorded, and a recording and presentation of the webinar will be available both on our Making Finance Work for Africa website, but we'll also email it to all participants and registrants of this webinar. And then finally, we would like to ask you to take a few minutes to fill the survey, which will appear at the end of this session once this webinar, once the window closes. So great, I will stop there now, and I will now give the floor to Mr. Stefan Alitembi, who is the Director of the Financial Sector Development Department of the African Development Bank, who will give the opening remarks. So Stefan, the floor is yours.
Thank you, Abdulkader, and I hope everybody can hear me. Good afternoon, ladies and gentlemen. I'm deeply honored to welcome you today to the launch event of our report, Trade Finance in Africa, Trends over the Past Decade and Opportunities Ahead. First of all, I'd like to thank the AfDB team that produced this report, and special thanks also go to our partners from Afreximbank who contributed to making this work possible. The African Development Bank has long recognized the importance of trade and trade finance on the continent. Through its private sector and chief economist complexes, the AfDB initiated the first of a series of trade finance surveys back in 2013. The objective of the first study was to better understand the trade finance landscape in Africa and highlight the size of the financing gap, particularly following the 2007-2008 financial crisis. That first trade finance report was published in 2014. The second report, published in 2017, sought to examine the trade finance challenges faced by SMEs and new trade finance clients on the continent. The goal was to deepen the understanding of trade finance on the continent, following that of our first report. Both surveys generated findings that were widely accepted, and the reports have been frequently referenced by different stakeholders, even to this day. Today, the bank is pleased to present the results of its third survey on trade finance in Africa, covering the period 2011 to 2019. This is a comprehensive report providing a decade-long review of the trade finance landscape on the continent and other insights into the role that DFIs play in trade finance intermediaryship. It is built on the results and knowledge gained from the previous surveys and expanded coverage to explore in detail new factors underpinning trade finance transactions on the continent. The 2019 survey was conducted in collaboration with Afreximbank. The partnership leverages on the experience and networks of both institutions with key actors in the sector and has benefited from increased participation in the study. Trade is one of the most important drivers of economic growth. We all know that. Africa as a continent is yet to fully capture trade's growth enhancing benefits. Africa's share of global trade has actually decreased over the last 5 decades, from 4.4% to 3%. This is partly due to the trade finance constraints that exist on the continent. Unmet demand in trade finance is still at a staggering $81 billion as of 2019. Addressing these constraints requires a concerted effort between various actors in the industry, including, but not limited to, multilateral organizations, international and national regulators, and commercial banks. This report therefore aims to provide useful information for the trade finance community, particularly DFIs, as they seek to further their partnerships with commercial banks on the continent. The aim is to reduce these trade finance constraints by providing trade financing facilities and support, particularly in the key priority sectors of both Afreximbank and AfDB's, namely energy, agriculture, manufacturing, infrastructure, and regional integration. Both of our institutions remain confident that various partners will find this report helpful in their efforts to adapt their trade finance operations to the new challenges facing the thriving African business community and trade finance industry amid the COVID-19 pandemic. Thank you very much, and I wish you a very interesting conversation.
Thank you. Thank you very much, Stefan. I will now turn to Mr. Eugene Bempong, who is the Chief Research Economist at the African Development Bank, to present the trade finance report. Eugene, the floor is yours.
Okay, thank you, Ben Brahim, and thank you, Stefan, for that introduction. As already mentioned, my name is Eugene Bempong, and I'm the Chief Research Economist at the Research Department. Next slide, please. Yeah, so this is the third series in our report, and before then, we produced 2 previous reports. Please go ahead. Next slide. We produced 2 previous reports. The first report was launched in December 2014, and the idea then was to try to understand more broadly the trade finance sector in Africa. And what really led our interest in this study was that it was being mentioned all over that the size of the trade finance gap in Africa was about 25 billion. And we weren't sure exactly where these numbers were coming from. So we decided that to try to understand the sector more broadly, especially to get a sense of the size of the trade finance that is being intermediated by banks, and then the true value. At least get closer to the true value of the gap, we needed to work with commercial banks and central banks across the continent to come up with a study. So the first report actually was to understand the size of the gap and then also get a sense of how much of the trade finance financing was being intermediated by banks. But because the interest was for the sector more broadly, we actually didn't dive deeper. And so one of the first criticisms of that report was, questions about, SME sectors and, new entrants to the foreign market. So, firms that have not been exposed and are trying to enter international trade, given that most African governments were trying to promote market access for small businesses. So the second study was actually launched to try to dive deeper and understand the constraint in the trade finance sector being faced by small and medium-sized enterprises, and we actually discovered that there was a significant, underserving of SMEs. So this third report actually builds on those 2 previous studies, and the idea is to take a more decade-long view of the trade finance industry as a whole, and combine the data we have from the two previous reports and see, what the trend has been over the past 4 years, over the past 10 years. And then also, in addition to that, try to set a benchmark, for the decade ahead for the development finance institutions and commercial banks who operate in the sector, so that it will guide their operations going forward, both during the COVID-19 and hopefully after that. So to do that, what we did is we distributed questionnaires to all the banks across the continent, actually, 51 banks, I think, countries across the continent, and we had responses from 49 countries. And the response rate is about 26%, which is sizable for a study of this type. And when we put all the data together, that is from 2011 to 2019, we have about over 2,300 observations from 670 individual banks. So based on this, we are actually able to understand the sector more broadly and see what the constraints and opportunities ahead are. Next. So just to give you an idea of the number of respondents to our survey, historically we've had very good response rate from our private banks. And this is not surprising because the distribution of the responses actually mirrors the type of bank ownership structure we have on the continent. So we have about 50% of the responses being from private foreign banks, and about a quarter of the responses are from majority locally owned private banks, and then the rest include state-owned banks and other types of banks we have on the continent. Next. So what we discover in terms of participation is that trade finance actually remains a very popular activity for banks across the continent. But the unfortunate aspect is that participation rate is actually going down. When we did the first study, when we published the first report in 2014, about 92–93% of banks reported that they were engaged in trade finance activities of some sort. But then if you look at the trend, coming from 2016 to 2019, participation rate actually continues to decrease. And in 2019, only 71% of banks that responded to our survey indicated that they are involved in trade finance. And the reasons they cited, were very obvious reasons. And most of them were very quick to point out that the key impediment to trade finance participation is new regulations. And as a lot of the African countries are moving to adapt new Basel III agreements, they are classifying the trade finance activity as a higher risk activity because it involves transnational transactions. And so banks are having to set up a very high amount of capital aside for them to be able to engage in this sector. And because of that, a lot of them are pulling. They are finding that it's not worth it for them, and they are pulling out of the trade finance activity. And the second challenge is, trying to find correspondent banks. And it's also, in a sense, related to the first one, because it comes back to the same thing. The correspondent banks are pulling away from the continent. Again, also because of issues related to regulations, anti-money laundering regulations, and know your client compliance. So a lot of the correspondent banks are sort of, cherry picking who they want to choose to do business with, because of all these risks involved in doing global business. And so those that are struggling to find these corresponding banking relationships are also pulling away from the trade finance sector. And the last reason they also cited is increasing competition, especially for the small banks. They said it's becoming more expensive to conduct due diligence for small businesses, especially for SMEs. And it's not only that the due diligence is expensive. Sometimes these firms are not able to provide the documents that they need to be able to carry on these due diligence. And so it's becoming more and more challenging for them. And for the small banks, with these increasing costs, they have no option than to exit the industry, the trade finance sector. Next. Yeah, so what we try to do is, first of all, get a sense of the distribution of the trade finance asset by bank. So we look at funded asset and unfunded assets, and it becomes very obvious that the importance of risk mitigating instrument for the trade finance sector in Africa. We observe across time that on average, about 60% of trade finance assets are actually unfunded. Unfunded instruments. So here we are looking at things like letters of credit and risk guarantee or risk mitigation, risk participation agreements, and then we have about 40% of them being funded assets, such as pre-export finance and factoring products. And if you take all these together, it shows what we observe is that there is significant variability across time of trade finance assets for banks. And this actually mirrors, as we will see later in some of the slides, it mirrors the commodity booms and commodity price fluctuations across the continent. But what we see is that as African trade has gone down from 2012 to 2013 thereabout, the size of the trade finance assets are also decreasing, and they've fallen by about 30% between 2011 and 2019. Next, please. Yeah, so when we put all these together, what we both funded and unfunded assets, the average bank has about USD 360 million in trade finance assets. And what we try to do is we look at we ask the banks to provide us information about their total asset size, and we wanted to find out what share of it is trade finance asset consisting of. And what we see is that in about 14% of bank assets, trade finance contributes about 14% to total bank assets. Next. So given that we have information on funded and unfunded assets, and we also have a sense of the number of banks that operate on the continent, and we also ask them information about what share of the trade finance approval rate, we are able to get a sense of the size of the bank intermediated trade finance. And this is something we've tried to estimate since we started the survey in 2011. And so the average value actually we have is that bank intermediate about 400 billion of trade finance on average across the continent over the study period. And we try to put this in perspective by looking at the total African trade for the same period, which has averaged about USD 1 billion. It was very high in the from 2011 to 2014, but has sort of decreased quite a little bit. And when you take the ratio of the two, we see that banks intermediate actually about 40% of total African trade. And this seems quite low in two senses. One is that, banks are intermediating about half of less than half of African trade. But then also, if you compare it to the size of bank intermediated trade finance across the globe, that is about 80%. We know this from the ICC has been tracking this for a long time. The Asian Development Bank has also done some work on that. And so given that globally about 80% of trade is bank intermediated and Africa has 40%, that is actually quite a low number. But then what we see is that the trend is rising from 2015 to 2019. So you see in 2011 we had 31% of trade finance, African trade being bank intermediated, but in 2019 we have 53%. But before we get too excited about that, what you actually have to look at is, it's not that the size of the bank intermediate is increasing. What is actually, but it is the case that total African trade is decreasing. So when you take the ratio, the ratio is going up because we have a lower denominator. So you sort of see a bit of a bump in there, but it's because African trade, at least in value terms, because commodity prices are falling, it's decreasing. And so we see that the size of bank intermediated trade finance is going up. but not because we are doing well on the, on the financing side, but the side of trade value is going down. Next slide, please. And then we also look at the trade finance for intra-African trade. Here we have a bit of the good news, but we also, again, don't have to get too excited about that. What we see is that African trade on average, intra-African trade on average accounts for about 17% of total African trade, and this is also has stayed pretty much flat, as we can see with the yellow line over the past decade, right? And banks are also intermediating about 18% of intra-African trade. So if you take the total size of bank intermediated trade finance, 18% of it is dedicated to intra-African trade. So in value terms, if you see the green bars, in value terms, you might think it's small, but if you look at intra-African trade intermediated, as a share of, relative to intra-African trade as a share of total African trade, then that means that intra-African trade is actually not underserved by banks, as we typically hear that trade finance intra-region is very low. We don't observe that, at least over the past decade, right? But again, it comes back to the point that intra-African trade is still very low. If you compare to other parts of the world, like trade within the EU and trade within North America and in Asia, they are well over 40%. So 17% intra-regional trade in Africa is still quite low. Next. And then how important is trade finance to banks earning in Africa? We also try to get a sense of this, and what we see is that trade finance is a very lucrative venture for African banks. Remember, we saw in one of the previous slides that about 14% of total assets are trade finance assets. But in 2011, trade finance were contributing about 17% to total bank earnings, right? And this, we observe a downward trend from 17% between 2018 and 2019. This is down to about 10% on average. And again, the reasons become obvious, as indicated by the banks. Competition is one point. The banks are trying to undercut each other because more banks are trying to attract more volume. And then also the other reason is the falling commodity prices. So here on the demand side, the value is decreasing, and so banks are not doing that much of transactions. But one interesting thing we observe is that earnings have been going up for state-owned banks, whereas it's been going down for all other types of banks. And this is next, please. And this is what something we try to look into a bit deeper. Next slide, please. And to do that, we actually went back and looked at the average fees for letter of credit charged by banks. And what we discovered was that state-owned banks are actually charging almost 3 times letter of credit fees charged by private banks. And this has been going on from 2015 to 2019. And we're actually not very sure why we see this pattern, but what we try to speculate is that maybe these banks, these public banks, have access to some sort of captive clients who deal in trade issues related to state procurement and state transactions of that sort. Next. And then we also look at default rates. The default rates on average, for trade finance assets have been far lower than the gross default rate on total bank assets. For trade finance, the average is about 6%, whereas for total NPLs is about 11%, right? But again, if we take trade finance default rate and then we compare it with default on a range of trade finance activities across the globe, as we know it from the International Chamber of Commerce, default rate on trade finance assets in Africa are actually quite high if you compare 6%, 6.5% to about less than 3% on global trade finance activities. And the other thing we observe is that the default rate is trending upwards. In 2011, it was about 4%. Now we are seeing about 8%, right? But this also mirrors the gross NPLs we have for all bank activities as reported by the World Bank, as you can see from the orange line. Next, please. Now, the interesting thing is that we asked the banks about SME default rate. It's been going down quite a bit from 2011, 2014. We had about 14% default on trade finance activities. Now, the good news is, they average about 10%, and they've stayed quite, uniform from 2015 to 2011, right? And also, we also look at the default on trade finance activities by new clients, and that's stayed pretty much quite low for the entire period. Next, please. Now, about approval and rejection, the good news is that now banks are starting to approve more and more of trade finance transactions. So from 2011, banks said they approve about 75%. In 2018, 2019, now they are approving about 85, 88%, right? The unfortunate part is that SMEs, surprisingly, are now becoming more creditworthy, as we saw, with the default rate going down, but rejection rate for SMEs is actually going up, right? And they are more than almost a double. Please go to the next slide. And so, a key part of our study is to try to understand what is the size of the trade finance gap. And here, given that we have information on the approval rate and the rejection rate, we're actually able to estimate the size of the demand and the size, we use the size of the bank intermediated trade finance that we have earlier, to get a difference between how much trade finance the enterprises are demanding and how much the banks are are able to provide to them. And here what we see is that the trade finance gap actually fell from 120 billion in 2011 to almost about 70 billion in 2016. And you see the low value in 2016 of 70 billion actually reflects the nature of the trade, of trade in Africa in general, because African trade for the same period was actually at its lowest point in 2016. So it's not surprising, but then again, here we see from 2016, we started to see the gap also trending upwards, right? And in 2017, it reached 95 billion. But 2019 now we have about we estimate the gap to be about 82 billion US dollars. And then we take the period average and we see that the trade finance gap is about 91 billion. Now we try to put this in perspective by looking at the size of the trade finance gap globally, as has been estimated by the ICC and the Asian Development Bank. And here, we take the size of the gap we have for Africa. We did this for 2019, and the size of the gap we have for the global gap, and we see that the African gap, the trade finance gap for Africa actually constitutes about 5%, 5.5% of the trade finance, the global trade finance gap. Right? This is quite sizable. It might seem that 5.5 is low, but if you look at the fact that African trade is only 3% of the world's trade, right, then in proportionate terms, the gap is actually way bigger than Africa's size of world trade. So even though the trend is coming down, we think that it still remains quite sizable. Next, please. And we try to understand some of the reasons why the trade finance gap decreased and then also started trending up. And the reasons for it decreasing is that because of the awareness being created about the size of the gap. And here, I think the DFIs have done a tremendous job. Not only the African Development Bank and the Afreximbank, but the ICC and the ADB, they've also done quite a bit of work in trying to attract attention to the sector. And so because of that, you have a whole host of DFIs, both at the global level and at the sub-regional level, trying to work together to help banks overcome some of the challenges, right? And then DFIs are not only also creating awareness, but they are also giving the banks a lot of support, both in terms of financing, things like short-term credit facilities, risk participation agreements with confirming banks, and also doing quite a bit of training to some of these banks to get engaged in the sector. And so these actually have contributed to bringing the gap down, right? The other reason is that trade value has also been falling. So on the demand side, the firms are not demanding as much as they used to, and so given that even if the supply trade finance supply stays constant, then the gap shrinks a little bit, right? But so far we don't have a difference. We are not able to estimate what part of the decrease is based on awareness or DFI support or falling commodity value. But then we also try to look into why the gap has all of a sudden started trending up from 2016. As I mentioned earlier, part of it is that trade value was low at the time. But then again, here the banks are very quick to point issues of anti-money laundering regulations and know your client regulations. And again, they also mentioned that as they are moving to adopt Basel III agreements, now it's becoming more and more expensive to sell, especially small banks. Argue that it's becoming more and more expensive for them to engage in the sector, and so they have to reject a lot of the transaction. And SMEs often, as we saw, are the enterprises who are actually suffer the most when the bank decide to pull to reduce the amount of financing they provide. Next, please. Right. And here we try to understand the reasons for rejection in general, for the sector in general, and we are beginning to see a much broader trend of some of these issues being structural. So if you look at things like client credit worthiness and size of availability of collateral, we did not include data from 2011 to 2012 because we had some of the components that are very different. But at least for 2013, 2014, if you look at client credit worthiness, 35% of banks indicated that as one of their major constraints, and then also insufficient collateral. We had about 30% of banks indicating that as their major constraint. Now these have not changed much. They've fallen quite a little bit, but they are still significant. You see, 2015, 2019. Still 30% of banks says, credit issues are a major constraint, and then insufficient collateral, 35% of banks also indicate that to be a major constraint. Now, one of the interesting things we observe here, and I think this is important for everyone to note, is that in the previous studies, less than 0.1% of banks indicated know your client regulations and anti-money laundering issues as a major challenge. Now, between 2015 and 2019, most of them are indicating this. About 16% are indicating that this is becoming an issue, and we think this is tied into the reasons why SMEs are having higher rejection rates, and also some of the banks are also pulling away from the industry. And here we are not only talking about say issuing banks or banks that give free export finance, but also we think it also explains why a lot of the confirming banks are also leaving the continent. Next, please. And here we look at the reasons again for the trade finance supply. So here the supply in general, not just the rejection rate. The competition becomes an issue. Correspondent banking, like you mentioned, is also an issue. Foreign exchange is an issue, and these are also issues that were there also in 2013, 2014. They've not changed much. And we also asked about intra-African trade in general, and issues also mirror a similar pattern. Next, please. Right. Now here we look at corresponding relationships. So we asked the banks, to rank their top corresponding banks. Here we are looking at African issuing banks. And we observe the same big players who are very active in the trade finance industry, as before. So we have, Citibank, Commerzbank, Dutch Bank, Standard Chartered Bank, and UBF are, the top confirming banks in Africa. But, they've remained so consistently from 2011 to 2018. But what is interesting here is that the number of banks, the percentage of banks that are indicating these banks as their top confirming banks is actually decreasing, with the exception of Citibank. If you look at 2011, 2012, with the first chart on your right, Citibank had 9% of issuing banks, indicating that they had confirmation relationship with Citibank. And at that time, it was ranked second. Now, Citibank is ranked first, with the same 9%. Commerzbank, between 2013 and 2014, had 10%. Now, it has 6%. So it shows you generally, how, even though, these are the big players, but the number of relationships they have is actually decreasing across time, right? And then we have a few banks, from emerging markets that are coming up. So we have Netris, which ranks 9th, and then we also have FinBank. I think this is a Maltese-based bank that has actually become very active in Africa with support from the IFC and other DFIs through risk participation agreements and short-term liquidity for trade finance. Next. And not only that, we also observe, we ask the banks to give us information about, the volume of activities confirmed by the top 5 clients. And here again, you see, just to confirm that the correspondent relationship is retreating on the continent. We see the downward trend in 2015, about 63%. The top 5 confirming banks confirmed about 63% of trade transactions. And by 2019, that is down to about 40%, 47%. So this gives us a general sense that, indeed, confirming banks are, even if present, they are reducing their size. Not only the relationship they have at the extensive margin, they are reducing it, but also at the intensive margin, the volume of transactions they process is also decreasing across the continent. Next. And then the role of DFI. So we, for the first time, we asked the banks to give us a sense of, their relationship with DFIs, and 60% of banks, and here we are talking of banks, that participate in trade finance only, not, the bank that responded to the entire survey. So 60% of banks that participated in trade finance for the study period indicated that they have a relation, they have some support for trade finance activity from DFIs. But what is interesting is that, is the distribution of DFI support. So if you look at a regional level, we see that most of DFI activities support for these banks is concentrated in Southern and West Africa, right? And then also, if you look at the distribution by bank type, it's actually more concentrated among foreign private banks. And this is probably not surprising, because when we ask the banks, about some of the challenges they face, especially the local private banks, and to a larger extent, the state-owned banks indicated that some of them have challenges understanding, the range of products that are available to them, or some of them were not even aware that, DFIs can provide them the support they needed for their trade finance activities. Next, please. So in terms of policy recommendations, we think there are a lot, but the key things that we need to note, I think, is the awareness that these new Basel III special regulations have created for the banks. Like I mentioned earlier, as trade finance is being classified as a riskier form of transaction, banks are having to set aside a lot of resources to be able to engage in that. And so we need to raise awareness about the unintended consequences of these new banking rules at least for the trade finance sector. And given that the default rate on these activities consistently remains quite low, we think that there is the need to actually sort of classify trade finance at least in a category where it will be, banks don't have to set up a lot of risk capital to be able to engage in it. And also, the nature of the stringent nature of these KYC compliance is also an issue. The other challenge is the SMEs. It seems that what we observe is that there is more to the SME rejection rate than just poor credit worthiness, because we observe that credit ratings, default rates are at least improving for SMEs, but at the same time, because when the banks are pulling up from the industry, SMEs are the ones that actually suffer the most, right? And then also the nature of the DFI support. Here I want to pause and note that DFI support is concentrated, like I mentioned, in Western and Southern Africa, and these are also the regions that actually engage in a lot of trade. Their trade volumes are higher than the other regions. But nonetheless, we think it's important to address these regional disparities, especially in areas like Central Africa, where the banks complain quite about that. Not only do they suffer from getting correspondent relationships, but they hardly receive any form of DFI support for their trade finance activities. And also the issue of creditworthiness, we think, is one that consistently has to be addressed, because it seems like it's a structural issue that has gone on as far as we've undertaken the study. So thank you. The report is dense. There's a lot of information. I could only present the key findings, but take a look at the report at some date. If you have any questions, I'll be here and hopefully be able to answer some of them. Thank you.
Well, thank you very much, Eugene. Some very interesting findings indeed coming out of the study, and it will also be interesting to see what further impact will this COVID pandemic will have on increasing the trade finance gap, or also on reducing the trade finance participation from banks. So I'm sure our audience will have a lot of questions, and just a reminder to everybody to please feel free to submit your questions anytime during this session. So what we'll do now is we will now move to the panel discussion of the webinar, and moderating the session is Ms. Lola Musu, who is the Principal Research Economist for the African Development Bank. I will turn to you, Lola, to lead the session and also to introduce to the speakers as well. The floor is yours.
Perfect. Thank you very much, Abdulkader. So, hi everyone, my name is Lola, and I am Principal Research Economist at the African Development Bank. And I am pleased to announce our three very key speakers. So the first is Mr. Suleiman Diagne, and this is in no particular order, so please don't take offense. Group Head of Trade at the EcoBank Transnational Incorporated. We have Mr. Blemming Nakati, who is the Chief Trade Finance Officer here at the African Development Bank. And we have Mrs. Gwen Mwaba, Director, Global Head of Trade at Afreximbank. Welcome to you all, our dear speakers. And so perhaps if you would allow me to indulge and start with Mr. Blemming Nakati as the AfDB speaker. Mr. Blemming, just a question for you. So we heard from Eugene that over the recent times, banks seem to be getting more support from DFI, so it's about 60% that responded positively in terms of DFI support. So from the AfDB's perspective, can you tell us how DFIs have managed to achieve this, and how important the support is for the bank's work moving forward on trade finance?
Good afternoon, Lola, and good afternoon to the participants on this webinar. Thank you for your question. DFIs indeed in Africa are doing a lot and engaged in supporting trade finance, including all the institutions that are involved in this space. And from your question, when you talk of 60% of banks, that's a huge percentage of banks that are benefiting from DFIs. However, in my response, I will focus on what we have done as the African Development Bank, in particular, in contributing to this support. Before I get into that, perhaps firstly, let me kind of put a historical perspective on what the involvement of the African Development Bank has been in this sector. So if you go in the historical sense, we have been relying on our special purpose partner, Afreximbank, as the main channel that would serve Africa's trade finance needs. And for those that might have this historical perspective, they would know that even the concept of setting up Afreximbank was incubated in the AfDB. We became one of the founding shareholders when it was finally set up in 1995. If we take a few steps back, you can look at in as far back as 1985, we were also a founding shareholder in the Trade and Development Bank, also commonly known as TDB, which is another active trade finance participant on the continent. So with that kind of background, over the years, our partnership progressed and grew, and it became apparent that there was a large structural gap in trade finance. And Eugene mentioned the first survey report that was published in 2014. It showed that this gap was sitting at about US $120 billion. This current report obviously is showing that the figure is improved somewhat, although it's still a sizable figure of about 80 billion. So this got the bank thinking, what could be done in order to intervene further and support these institutions that were so much close to us and were involved in their founding. And two scenarios emerged. We could either scale up our support in the form of we were shareholders, we're providing other tools like your liquidity support and guarantee instruments, or we could also initiate our in-house trade finance program. So no doubt, if you look at the numbers that we are talking about here, these solutions were not mutually exclusive. They could be implemented at the same time. And we considered that our trade finance program would be complementary as opposed to crowding out TDB, Afreximbank, and other FIs such as EcoBank who are also part of this this seminar. So if you look at this number of 80 billion that has just been indicated as the gap in the latest report, it means that the intervention of all MDBs that are active on the continent beyond the regional institutions that I've just mentioned is important. So the second way that I'm looking at this question is that since our founding of our fully fledged trade finance program in 2013, we have managed to support a number of financial institutions on the continent. And I'll give you a bit of statistics. But before I do so, we were already looking as a bank in providing direct intervention in the trade finance space between 2009 and 2012 in response to the financial crisis that was experienced around 2008, 2009. So at that time, we put in place two major programs that totaled about $1 billion US. The first intervention involved us investing about $500 million as our contribution to an initiative called the Global Trade Liquidity Program, which is a collaborative initiative, but it was led by the IFC in order to support African FIs who were experiencing some difficulties when international banks were retreating to their markets at that time. Then the second intervention at the time was an additional $500 million, which we sort of introduced as a trade finance line of credit program. And we identified a number of banks that could benefit at that time when we launched it around 2009, 2012. Since then, forming our own program, we have supported more than 324 financial institutions across 44 African countries and supported trade to the value of about US $8 billion, the trade flows that we have been supported from our interventions. And this is a program that was only launched as a full-fledged program in 2013. So one could be asking a question, how did we manage to achieve such a feat in a very short space of time? I can mention that this was primarily due to the type of financial instruments that we introduced. And our flagship one, which is an instrument that we call the Risk Participation Agreement, helped us provide at scale, a portfolio-based unfunded risk participation guarantee structure using our AAA rating. And we have managed to work with a number of regional and international commercial banks, which provide confirmation capacity to an existing network of a range of banks that issue trade instruments from the continent. So this is a wholesale approach, which requires that we rely typically on these partner banks, which are confirming banks, international banks, and they will take the lead in performing due diligence on African IDs. They will take the lead in originating the transactions. They will take the lead in processing. They will also take the lead in monitoring these guaranteed transactions once they are sort of under implementation. So that way we have managed in a short space of time to reach hundreds of African IDs without the need to deploy significant human resources in that endeavor. So we also have got an additional instrument that we call the Trade Finance Line of Credit, which provides liquidity support. This is a funded instrument which we make available to eligible banks, so that they can in turn on lend to their clients that finance international trade. And using that instrument, we have also managed to reach out to a significant number of financial institutions on the continent. I think I'll stop here for now, and we'll be ready to respond to a follow-up.
No, thank you very much for that. I mean, obviously there's been a lot of action going on in the trade finance space within the DFIs, particularly, as you said, the bank, AfDB and Afreximbank. So we expect at least that to continue moving forward. So my next question is for Mrs. Gwen, and this follows from what Blending has just discussed, which is, Afreximbank is the continent's sole export-import bank, right? And we've seen from the report that the share of bank intermediated trade finance is roughly around 40% compared to the global 80% numbers that we're seeing. So what is Afreximbank doing, or what can Afreximbank do to help raise this share of bank intermediated trade finance in Africa?
Yeah, thank you very much, Lola, and a very good day to all our participants on the webinar today. So Afreximbank is contributing to raising the share of bank intermediated trade finance in Africa in a number of ways. Firstly, we continue with our core business, which we have done for 25 years, which comes in the form of several programs and facilities that are targeted to certain sectors across the continent. But if I just touch on a few key themes in terms of the interventions of Afreximbank, I think firstly, we're always striving to reach the SME sector, as this is where the gap in trade financing is largely prevalent. Now, because we can't lend to SMEs directly, being a wholesale DFI in nature, we continue to build and use those relationships that we have established with African financial institutions in order to reach this important segment of the market. And you will find that when you look at our annual reports, our share in terms of trade portfolio that is at risk with financial institutions makes up about 60% of our total exposure, because of the interventions that we use in using financial institutions as an intermediary. We're also at the moment working on introducing a supply chain finance program, And again, this program will focus initially on payables finance, which is very well suited to catering to the needs of SMEs who are involved in various supply chains. So it's our hope that this alternative form of financing will also increase the level of intermediated trade finance from Afreximbank. And I would say over the last 2.5 or so years, we have recognized the fact that every time there's a commodity crisis or any other type of economic event affecting the African continent, the first reaction from international banks, and this was alluded to during the presentation on the results of the survey, is we see a withdrawal of international banks from the African continent. And if they're not withdrawing completely, they're scaling back their limits to such an extent that it leaves our African countries constrained in terms of meeting the demands for the trade financing that they require. So Afreximbank has positioned itself as a correspondent bank for African banks, and we're stepping in to fill that gap that is often left by these international banks when they take the view to withdraw from the African continent. And we're doing that predominantly through our flagship LC confirmation program, which we call the Afreximbank Trade Facilitation Facility, or AfTraf for short. And the goal of this facility is to make sure that we can provide LC confirmation lines to as many African banks as possible over the next couple of years. In fact, we have a hard target and aspiration to reach a minimum of 550 banks on the African continent. Since we actively started pushing and developing this program, we have completed KYC on around 350 banks. And out of those 350 banks, we have already got active LC confirmation limits in place for around 128 banks across Africa. So quite a way to go to our 550, but we're making good progress. And we again expect that this will be one way in which Afreximbank will help to close that trade financing gap that continues to exist. And in addition to this, we also have a very active guarantees program. And this program is primarily targeting those counterparties who are not able to take African risk because of the perceived higher risk of African activity and Africa in general. So those banks that I spoke about that are withdrawing from the African continent can also benefit from this guarantee program, because this will provide them with cover to enable them to assume Afreximbank risk instead of the risk of the underlying African FI. And in this way, we hope that they won't withdraw, they will continue to provide capacity to African banks, because the demand is just so large. We do need to collaborate and work with our international partners as well. So we're happy to provide them with that cover to ensure that that continues to happen. So that's on the transactional side. Now on the non-transactional side, we have a couple of initiatives as well. Some of you may be aware of our KYC repository, which is called Mansa, which was launched recently. And we all know from the survey that KYC is one of the impediments to trade finance on the African continent. So we hope that by creating this repository and making it available to those that want to lend to African counterparties, this will also help to increase access to trade finance, because access to KYC information should no longer be as big an impediment as it has been in the past. And then finally, I'll just say that one of the other impediments that we have observed, particularly as it relates to intra-African trade, is the payments systems, where there's a lot of trade, formal and informal, that goes on the African continent, but payments is generally challenging because local participants, before they import a product from a neighboring African country, have to convert their local currency to US dollars to pay a counterparty in another African country who receives the US dollars and then converts it into the local currency. So we are in the advanced stages of launching our Pan-African payment and settlement system, which will basically enable counterparties to trade amongst themselves within Africa, but pay for goods in their local currency, and then the recipient would receive the payment in their own local currency. And once again, we hope that this will be a huge contributor to stimulating bank intermediated trade on the continent, because there will be financing programs attached to that system. So I'll hand back to you for now, Lola.
Now, thank you very much, Gwen. So just a quick follow-up and I'll move on. So this payment system, you hope to have it live when?
Unfortunately, I don't have a timeline at the moment, but it's at a very, very advanced stage at the moment. In fact, I think the pilot program is actually ongoing at the moment, so it's quite imminent.
Okay, and the KYC depository, I think that's very practical and useful, and that will lead me to my question to Suleiman, who is the flag bearer, I believe, for commercial banks here on this panel. And so we see from the studies that stringent KYC and AML regulations have led to some scaling back of activities from the continent. So what changes, as you hear Mrs. Glenn spoke about what Afreximbank is doing, both on the transactional and non-transactional side. But from your perspective, what changes to existing regulations or processes would you recommend or would you like to see in order to increase the acceptance rate of trade finance applications by banks on the continent?
Thank you very much, Mrs. Amuso. I want to first thank the panel members and say good morning to all the participants. And on behalf of EcoBank, of course, we recognize the partnership that we've had with Afreximbank, but also the African Development Bank. And this partnership has been historical, and we look forward to continuing to partner with them in developing African trade. So to come back to your questions, and I think one of the key findings of the report cover this point, which is basically the emergence of the fact that more and more SMEs are actually finding out some impediments in basically getting their trade finance channels through banks, both regionally and more importantly, internationally. And this is obviously a very key impediment because, as we all know, SMEs constitute 80% of the businesses in Africa. And by virtue of their size, the size of the transaction for SMEs are relatively low. And on the other hand, because of the developing issues regarding AML and KYCs and the need for the strengthening of those processes, it has actually become pretty much of a burden, and from a cost perspective, for international banks to develop some of the platforms to ensure that all the requirements from a KYC but AML perspectives are met. And obviously that had some cost implication for most of the banks. And the cost per transaction virtually and automatically increased based on that. And because at the same time, the environment had actually been conducive to some of the banks being penalized, that has actually led to some de-risking techniques or strategies for some of the international banks. And unfortunately, SMEs being 80% of the population of our businesses have been impacted based on the fact that obviously those banks have actually arbitraged for larger transactions rather than support the SMEs. So I think one of the key points to basically alleviate the current strain from an AML KYC perspective is to improve on the processes. I think it's going to be very important for all of us to recognize the fact that it's as we stand, given all these lingering issues regarding terrorism and issues regarding trade-based money laundering, it's very important for all of us to recognize the need to be compliant with those rules. But what we could advocate is obviously that for those rules to take more into account the realities of Africa. And one of the realities that obviously for example, could be cumbersome to find a very specific physical address for some of the SMEs, and this is related to the environment or the way our administrations are organized. So way forward, the way we look at it is that we have the processes, and we can actually improve on piggybacking on what exists already through partnership with public administration. And I'll give you an example. One of the key requirement obviously is the identification. And we know that to get a VAT, which is a tax registration ID number, it's all the businesses would go through the administration and submit all the relevant documentation to get that VAT. Yet, when the SMEs come to the banks, both regionally, locally, or for international trade, they have this requirement to submit all this documentation again. So, from a process point of view, we feel that there's a possibility that we look at leveraging on existing platform from an administrative point of view, not to duplicate what is already existing. And this is from a local standpoint. That's one, and this would have to be done through obviously the administration in our various countries across the continent. The second leg of that of what could help us improve on trade financing for African SMEs is also to ensure that these requirements for the international banks, because one of the key points also is that this requirement are imposed on us because of the virtue of international trade, being obviously using foreign currencies and having the nexus of correspondent banks, which are generally outside the continent and subject to regulations outside the continent. So there's also a path that we could advocate for our administrations, being the central banks or being the general administrations in our countries, to engage in partnership with the regulators outside the continent to ensure that once there's a framework that is agreed, that we have this set of documentation and these are our processes, and there could be even agreements or vetting of the processes that are done in our countries, that from those vetting of the process, they be master agreements between, say, regulators in, let's say, a zone like UMOA or CEMAC, and for example, the French regulator, so that there's also no duplication of the processes of KYC on the back of the satisfaction that they could have of existing processes at the origination of those transactions. So those are some of the sorts we can have, and certainly we would not do well in just looking at processes. I think we also need to improve on education of our SMEs clients. And in that perspective, we feel that there's also work to be done to support those SMEs to basically embark and be aware of those requirements and basically be able to compete and submit acceptable trade finance requests for banks across the world. And it is in that perspective that actually EcoBank has signed recently a master agreement with the African Union Development Agency to support SMEs in terms of providing technical assistance and basically supporting them in being offered some of the public procurement or public or regional market opportunities across the continent. Because once we agree that some of the AML or regulatory aspects are also imposed by virtue of the fact that trade is done from the continent, but also very at very large amounts outside the continent, we also need to probably pause and recognize the fact that the rate of intra-African trade, or the weight of that component of trade, is too low at 17%, as mentioned in the report. And it's probably also a good forum to mention the requirement for all of us to advocate for a very quick implementation or basically getting live into this AfCFTA, which is the African Free Continental Trade Area. That would basically also internalize some of these discussions around trade to the continent. And once we internalize, then we can obviously improve on processes, because these would be basically agreements that could be implemented through those common framework. So these are the things that we can look at. Obviously, looking at also what we can do in supporting the women business in still being able to compete and win over the trade finance landscape. Thank you.
Thank you very much, Mr. Suleiman. I think you brought up some very good points, acute. So part of what you mentioned on the processing side, is this something that you think that the KYC depository that Mrs. Marbo was talking about, the Afreximbank, has, is this something you think would assist in, so could that be a link between like the regulators and the banks in having like a common system where you can go in and pull information, and that would kind of streamline some of the costs of regulation?
Exactly, that's the exact idea, because like I was saying, obviously with economies of scale, the need to develop all these platforms, upgrade them on a periodic basis is obviously costly. So the more we can mutualize these aspects, the better. And I obviously salute also this initiative from the Afreximbank, under which we also adhere. We are also a member of that MEMSA platform. It's definitely a very strong step in the right direction. And this is the way forward. And for example, I can also mention one of the key milestones that we as a Pan-African bank operating over 33 countries have been able to do, working in tandem with regulators, is through our mobile app. For example, instead of creating a set of documentation for account opening, we've been able to piggyback and working in tandem with the regulators to ensure that we don't replicate, for example, the documentation that are submitted to create a SIM card through the mobile operators, and basically be able to leverage on those documentation requirements to create a free account, which we call express account. So these are some of the initiatives that could help, because, for example, out of the express account, although the transaction could be limited, there's a possibility to be basically transacting across 33 countries across the globe. This is obviously another strong step in the right direction. And obviously the transaction limits, once the regulators are more comfortable, we could look at improving them, but definitely those are the type of initiatives that would definitely go in the right way to improve trade financing for all of our clients and partners.
Thank you very much. I have a lot of questions that I would like to ask personally, but unfortunately time is not on our side, and we have questions that we're receiving from the audience, and so I will relegate to Abdul Kader so we can move to the section Q&A from our participants.
Great, thank you very much, Lola, and to our distinguished speakers for such an insightful messages, and for sharing your ideas, and also for some insights on the interesting work your respective organizations are doing. Yes, indeed, we are receiving plenty of questions, and I think also it might be a good idea to bring in Eugene as well in this next Q&A segment. So I'll try to combine questions together, as in we do have quite a number of them, and we're only 15 minutes away. So the first group of questions, first of all, is there's a question on looking at the scope of how the Africa Trade Insurance Initiative could assist the SME segment to tap into trade finance. So yeah, given that the lenders could greatly benefit from this insurance comfort, so looking at it from a trade finance insurance perspective, also sticking with questions on SMEs. There's another question well, let's go with this question on the role of the big banks in correspondent banking, and why can't we have banks such as African banks, such as Standard Bank or EcoBank, support AfDB and Afreximbank to provide the correspondent banking support for other local banks. So looking at the role of Pan-African banks in providing correspondent banking support. And then another maybe general question to Eugene on the availability of the data, whether it could be available publicly or not, or whether there are any privacy concerns with that. And then maybe I'll just add another question, and this is a question that also I had in mind as well, and it's looking at specifically on the role of financial intermediations. And the question is really, why can't trade finance facility be on-landed directly to large manufacturing or trading companies, which extends payments on account facility? So companies such as those that provide the payments on the supply of raw materials, commodities. And the follow-up question to that is, why is trade finance facility not available to finance trade infrastructures such as commodity exchanges, warehouses, technologies, and others? So I'll stop there, and maybe for the first question on Africa Trade Insurance, who would want to take a stab at that? Perhaps I'll turn to maybe the DFIs, starting with Lemming. The question here is related to the role of Africa Trade Insurance and how could they assist SMEs in tapping this trade finance.
Yes, let me take a step on that one. First of all, I think let me just highlight that we've got a very close working relationship with ATI. We are an equity participant. We're shareholders in ATI. And for the past 5 years, we have been involved in supporting their country mobilization program, where up to date, we have mobilized more than $71 million to support about 7 African countries become a member. The way ATI works is that for them to provide their credit risk support and political risk cover, a country, first of all, has got to be a member. They must pay up their subscriptions, and through the parliament, they must get the ratification done. So we believe that they are complementary to the work that we do, to the extent that as part of our broader balance sheet management activities, we have worked with ATI to provide insurance cover for part of our lending book. So the way I see ATI playing a big role, particularly on SME, would be in providing their cover to financial institutions so that they're in a position to guarantee their commitments when they reach out to getting funding from lending banks such as international banks, which are providing that would require that kind of security cover. I also see them providing insurance cover on factoring, because as you know, factoring is one way in which SMEs can access funding using open accounts. It's a sector that is very close to us as well, in the sense that if you look at the growth that the factoring industry has been experiencing worldwide, the past sort of 3 years, there's been year-on-year growth of about 8%. The number sitting probably at about 2.8 trillion. And yet in Africa, you're looking at factoring volume sitting at only about 24 billion euros as of last year, although growth is quite significant. So we look at factoring as one way in which the trade finance instruments that were indicated in the survey, and why it is a bit difficult for some type of financial institutions to access these trade finance facilities. We could have factoring as an alternative trade finance instrument that SMEs can access easily. And these type of financial institutions like your domestic smaller banks and state-owned banks, once they can start providing this type of instrument with guarantee support from an institution like the ATI, we can begin to see more SMEs benefiting from that type of trade finance facilitation. I think I'll stop here for now on that particular question, unless there's
Thank you, Blemming. Just while we have you online, would you want to take a stab on the question on the role of non-financial intermediaries like large manufacturers or those involved in supply chain, supply of raw materials? What do you think the role can be, and how can DFIs or how can AfDB specifically can support these beneficiaries in terms of closing the trade finance gap and also supporting various SME suppliers in the value chain? What do you think the future role of DFIs could be in this space?
So our existing trade finance program already provides for direct intervention with corporates, although we have restricted our participation to agricultural aggregators and agribusinesses. We have an instrument that we call soft commodity finance facility. And using that instrument, we can provide support for value chain operations of an agricultural company, supporting from farm gates, the procurement of commodities. We also provide, sort of working capital support, logistical support in terms of transporting that commodity to a warehouse. And often there's a requirement to add value, so that facility also provides support for that. And finally, we've got an element of providing post-shipment finance. What we have not done so far is extending the same to other non-agricultural companies, perhaps those that are involved in manufacturing of other goods which are outside of that sector that I've just mentioned. But it's a dynamic process, and we've got other institutions like I think Afreximbank who are already actively involved in supporting the other sectors. And I would imagine they have got a bit to say about some of the products that they would have, obviously, in supporting those. But for us, I think we took a strategic decision for now that our focus, in line with our Feed Africa strategy, would be only restricted to supporting agricultural companies in terms of their value chain operations by using that tool instrument that I've just indicated.
Thank you, Blemming. And maybe I'll turn now to Gwen if you want to maybe take a stab on either of the two questions I just asked, and specifically what is Afreximbank doing in supporting or lending directly to large manufacturing trading companies, or whether there's a facility in place to provide support trade financing in infrastructure such as commodity exchanges, warehouses, logistics, and such.
Yeah, no, thanks very much. I'm starting with the first question, which I think was around ATI and how, you know, a DFI could potentially leverage off the products that ATI offers. Fleming touched on an important point that I wanted to make, which is around factoring, because factoring is a very well-suited product for SMEs. And Afreximbank over the last few years, I would say 5 years or so, has been very active on the African continent, trying to create awareness and stimulate interest for factoring companies to set up and start offering factoring services to their clients, and also for African banks to offer factoring as a product set or a division within their banking organizations. Now, there have been a number of challenges with getting the rate of growth that we anticipate. The first, I think, was around the fact that there wasn't a model law for factoring in Africa, but that has since been overcome with the intervention of Afreximbank, who worked on a model law currently under consideration by the various countries. That being said, the other challenges that we found with stimulating growth in the area of factoring was the fact that, again, because it's very SME focused, many of the SMEs, including the factoring companies themselves that were trying to set up to offer this product, did not qualify to meet our direct lending criteria because of the various risk elements that often crop up when you're dealing with SMEs. So we, as a Afreximbank, are overcoming or trying to overcome that problem by working with counterparties such as ATI, who could potentially, as Fleming had alluded to, offer a credit risk insurance. So that where a counterparty does not qualify for direct access to financing because they don't meet our criteria, we can leverage off the risk rating of the insurer through the insurance product that they would wrap around the transaction. So there's great relevance for ATI in that space. Another area that perhaps ATI could help with intervention is the area of foreign currency convertibility risk. As you know, Africa is a net importer of most goods and services, and foreign exchange remains a challenge. Sometimes it's availability, not because there isn't foreign exchange in the market, but because of timing. So if there was an insurer that was able to take foreign currency convertibility risk, I think this also would contribute greatly to enabling DFIs such as Afreximbank to do more for clients that are looking to import into certain markets. Then moving on to the second question around how the bank can support companies that are in manufacturing or SMEs, etc. Outside of the financial institutions that we use as intermediaries to access the SME market or support the SME market, this actually is our bread and butter. We do have direct lending programs where we support corporates directly if they meet our minimum risk acceptance criteria. And perhaps I'll just take the opportunity to highlight 3 key criteria that need to be met from a trade financing perspective. The first one is the company needs to have a minimum turnover of at least $10 million. They need to have at least 3 years of audited accounts, and they need to have a net asset value in terms of the size of their balance sheet of at least $2 million. And we lowered the threshold actually to these levels to be able to try and reach more corporates. And we have a very broad suite of products and facilities that we offer to clients, from vanilla trade that I spoke about, where we issue letters of credit directly. We do receivables financing. We do contract monetization financing. We do trade finance for soft and hard commodities. We offer reserve-based lending for people in the oil and gas sector and in the mining sector. We do pre-export and pre-shipment financing, and the list goes on and on. So we have various suites of products to suit most sectors of sectors. And then in closing, we also have a project finance team which can facilitate or support corporates that are looking to develop trade enabling infrastructure. So within the project finance team, some of the criteria that I spoke about for the trade finance element may not apply. So what I would say to any clients who are interested in learning more about our products and services is to please reach out and we can talk to them about their specific needs and requirements. Thank you.
Thank you very much, Gwen. Perhaps I'll turn very quickly to our colleague from Ecobank, Suleiman. Just a quick question. There was a question on whether Pan-African banks like Ecobank or Standard Bank play a correspondent banking role, and what would be required to, from an advocacy perspective or from a policy perspective, to enable such an initiative.
Thank you. Yes, first, obviously, I think it's probably good to pay a tribute to our founding fathers at Ecobank, because the vision was great in terms of really creating a bank that could be operating across the continent and looking at operation across 33 countries in the continent out of the 54, 55 countries. So the first point to raise is the fact that banks like us have a duty to ensure that from a compliance perspective and from a financing access perspective, our international banks or correspondent banks are generally comfortable, which means that we obviously need to be fully compliant, but more importantly, because of the size of our reach across the countries, but also in terms of number of customers and volume of trade. I think the report was mentioning 14% of trade balance sheet being devoted to trade, whereas at Ecobank we are a bit more than 20%, showing really the focus over trade. What we've been able to do is also forge some very long-lasting partnership with key top banks across the globe, in order to basically create enough volume to support the need to basically support trade finance across the continent. And I think it is through those partnerships with large banks, but fewer large banks, to ensure that the volume would basically ensure that the pricing is right, and yet they can still support the requirement from a KYC perspective. These are, I think, some of the initiatives that we as at Ecobank have been able to help do. But it's not really the end of the story. We find that it's actually, from a vision perspective, we've created a financial operation in Paris. And this operation and this affiliate we call Ecobank International is based in Paris, is able to basically also be used as a gateway to intermediate trade transactions across the continent. Not only for Ecobank affiliate, but across all the issuing banks in the continent. And we definitely are getting very much traction on that, because we know the transaction. We are present in Africa. We obviously be able to testify more and document more in terms of the requirements, and piggyback and still partner with DFIs. I think Afreximbank's AfTraf initiative is a great one on which we've been able to leverage to improve the capacity in terms of basically being able to broker or confirm lines across the issuing banks in the continent, and basically be able to also leverage on this partnership, because we're looking at also partnering with AfDB in order to improve on the capacity, both in terms of risk sharing, but also in terms of confirmation line. And this could be done through a gateway hub of Paris, being an African bank rather than a foreign correspondent bank that may not have all the realities across the continent. So these are some of the initiatives that we're doing in order to continue to improve and continue to broker some of the trade finance transactions across the continent.
Thank you very much, Suleiman, and thank you for sharing that vision of the EcoBank International operations in Paris. We'll be certainly following up on you on that. Before I bring in Eugene in this discussion, I just we're getting quite a few number of questions, and so we have decided maybe to extend the session for another 15 minutes, if that is okay with everyone, just so that we can get a chance to answer some of these questions, which are, and it's really making for a very interesting conversation. Just to, maybe I'll bring in Eugene here very quickly, and I'll try to group some different questions there. So there's a first question about making whether the data can be public or not. And then a follow-up question in terms of the informal MSMEs and whether they're, they're accounted for at all in consolidating data of the landscape of Africa finance. So whether informal MSMEs are at all taken into account. And then a question on whether there's been any comprehensive data on the offering of different instruments by different players in the African trade finance market. And have you, based on that data, have you seen an increase, for example, in demand of local currency facilities, for example? So the first question on the data itself, whether it can be public, the data on informal MSMEs, then on instruments themselves, and specifically on local currency facilities.
And this is to me, right?
Yeah, I mean, if you, yeah, sure. I mean, and then we can open it up to the other panelists.
Right. I think the last question should go to the panelists because I'm just a researcher. I'm not a practitioner, so probably I'll leave that question to them. I think in terms of the data being available, this is a decision that has to be made at the at the management level. Obviously, this is very sensitive data to some extent because the banks are reluctant to share a lot of the information we have to the public. But if there is any researcher out there who is interested in using the data, we welcome our collaboration, and then we can work to solve issues about privacy and anonymize the data and use it in some fashion if we see the data being used in the appropriate way. Right? But for now, the data is not publicly available, but I think we can review requests on a case-by-case basis, and this will be a decision for the AfDB management. The second question on informal banks, I will say no, and this is so all the data we have is mostly come from the banks, and we will imagine that only formal SMEs can do trade transactions with banks because you need to show proof of having been a legal business and things like that. So no, I will say we don't have data on informal SMEs. They most likely are not in our sample because it follows from the fact that they cannot get trade financing from banks if you are an informal or illegal SME business. So we don't have these enterprises in our sample. And I think I'll leave the last question, like I said, to the practitioners.
Thank you, Eugene. Maybe I'll also bring also the rest of the panelists. I'll maybe ask a couple of more questions, and then we can decide between each other who will answer which question. There was one on specific innovative instruments to enhance SMEs, particularly from a woman's lens. And the question is whether DFIs would be willing to take risks or to de-risk SMEs, and particularly women-owned SMEs, since, well, we haven't seen the data, and I'm sure there is a lot that there are disproportionately, a lot of these trade finance facilities maybe are disproportionate to women-owned SMEs. The other question, perhaps just to combine the currency question. So there was the initial question asked before about whether there's an increased demand of local currency facilities, and also a question on how do you handle the challenge of currency risk for intra-Africa trade financing, given the weaknesses that we're seeing with the local currencies in most African countries. So maybe I'll stop there, and anybody who wants to take a stab at these two questions? Perhaps Gwen on women-owned SMEs?
Yeah, thanks very much. Actually, in addition to the women-owned SMEs question, I was going to also respond to the one on currency risk, because I think that's related to what I spoke about in my earlier presentation. So yes, absolutely. We are very partial to supporting women-owned businesses and would encourage women and continue to encourage women-owned businesses in all that we do. We have supported some women-owned businesses already in key sectors such as cocoa. There's one client in Ghana, which is an all-woman-owned business, from the CEO, from network on the factory floor. You know, they were previously trading cocoa beans, and we supported them with financing the manufacturing plant, which enables them to now export semi-processed cocoa in the form of cocoa butter, cocoa liquor, and cocoa cake. And as a result of that, they were able to cut out the intermediaries and supply companies like Hershey's and Nestle directly, which is great. So the short answer is yes. All of our instruments are suitable, and where the applicants are struggling to package their proposals, we can assist with directing them to the right types of resources that can help them to package their business plans in a manner that makes them bankable, so that we can support them accordingly. Then on the second question around how do we mitigate the currency risk within intra-African trade given the volatility of African currencies, and it's exactly because of that point that our payment and settlement platform has been developed, because the idea is that you do not need to take one local currency to convert it to an international currency to make a payment for your goods and services. So basically, if I can give a short illustration of how it would work in practice, if I am sitting in Kenya and I want to purchase some goods from Nigeria, for example. And also, let me just make the point that linked to this payment platform will be an e-commerce marketplace. So people will be able to log on to this e-commerce marketplace, look for the product that they want, identify a supplier. Once they find the product that they're looking for, and in my example where I'm sitting in Kenya purchasing goods from Nigeria, I find a Nigerian supplier, I will place my order on the e-commerce platform, make the payment, and pay for it in my local currency in Kenyan shillings. The recipient on the Nigerian side will receive the equivalent in local currency in Nigerian naira. Now, what this does at the end of the day, because these platforms obviously are being done in collaboration with the African central banks, at the end of the day, the only exposure to US dollar is the net settlement amount after the trading has closed. So this will significantly reduce the strain on US dollars on the African continent. And of course, the big benefit to the buyers and sellers is they don't have to continually suffer the exchange risk or even currency availability risk that exists at the moment when you're trying to trade intra-regionally. Thank you.
Thank you very much, Gwen. So maybe I'll try to, for the interest of time, I will ask maybe a couple more questions. I don't know if Suleiman, did you want to weigh in on what was just said?
Yeah, sure. I just wanted to mention, because I think one of the questions was related to the women in business, and we all know the importance of that that segment of our client base. I just wanted to also mention that under our EVE initiative that we have here in EcoBank, we intend to partner with the African Development Bank under this AFAWA initiative. And for us at EcoBank, we are looking at really supporting this women business and lend up to $130 million, to a total of 100,000 women business. So it's an initiative that we have at the heart of our strategy, and we really recognize the fact that in order to win within the SME space, constituted majorly by women, we need to really cater to that specific part of the portfolio. The second point on currency, I wanted to also weigh in on that one because I think, and this COVID-19 has impacted some of the commodity heavily dependent countries. And this is probably an area where it's going to be important to see more support from the DFIs. And it's important that while the commercial banks may not always be willing to take some of the cross-border country risk, we see more contrarian move from the DFIs to really come and support commercial banks in basically continuing to do and support trade business in some countries. Having said that, I've also mentioned the platform, right? The fact that we are already in the majority of the regional monetary zone mitigates the need to really change platform. When we look at CEMAC or the Franc zone generally, you are with the SADC zone. These are platform where, as a bank with a large network, we are already present. And I've also mentioned our payment capabilities and leveraging also on technology. We've developed a platform, we call it Omni, that basically allows to be able, from the comfort of your office, to trade on the platform and across multiple currencies across the continent and the group. So we are making good steps, but certainly more support would be needed in order to alleviate some of the currency mismatches that we see in some of the trades. Thank you.
Thank you, Suleiman. So as I mentioned, I'll just we'll try to answer a couple more questions, and then we'll go to the closing remarks. Just a question on the role of African Development Bank and Afreximbank in leveraging the Africa Free Trade Agreement. And then another question on supply chain finance, and given the reliance on automated platforms, whether financial institutions and other corporates are ready for this new model, and whether there's any plans to implement supply chain model in place. So who wants to take either of these questions first? Gwen, you want to go first?
Yes, thanks very much. So on the AfCFTA, yes, Afreximbank actually has a huge number of initiatives going on at the moment, one of which is an industrialization program where we are financing the development of industrial parks in various African countries. What this will do is it will create manufacturing, particularly light manufacturing capacity on the African continent. And the idea is that these goods and services can then be sold to other African countries, obviously taking advantage of AfCFTA. Secondly, Afreximbank is also active in creating export trading companies, which enables producers of goods and services in various African countries to consolidate and aggregate these commodities from various African countries without incurring the attendant duties, of course, sort the commodity, perhaps semi-process, brand, and then export under one brand. So again, AfCFTA will help greatly with this particular export trading company initiative. Then the second question, sorry, just remind me, that was on supply chain finance and the fact that it's a technology-driven platform. Yeah. So Afreximbank again recognized this. We did absolutely recognize that this is an impediment, and of course for commercial banks across the African, it would be an impediment to them deploying supply chain finance in its proper form, which the person that's asking is absolutely correct, is a technology-driven platform. There are a few programs on the African continent led by a few global banks, such as I think Citibank has a big program, but this is really to support their multinational clients. So in recognizing the implement of the cost of supply chain finance, Afreximbank is actually taking the lead in facilitating a technology-based supply chain finance program. And again, we're at a very advanced stage and moving into a pilot stage where we've already identified and selected our preferred technology partner, which is a big global technology provider of supply chain finance. And we'll be deploying this in various African countries, working with local African banks, where this technology facilitated by Afreximbank will be deployed so that we can start to offer the proper technology-based solution, where this technology will then also be linked into the buyers who sign up to the program. Thank you.
Thank you, Gwen. Perhaps any last words from Blemming, and then we'll take it from Suleiman, and then we'll wrap this up.
So from my end, I think there's just 2 or 3 quick issues I wanted to talk about. From the ACFTA, there's a lot of work that the bank is doing from a sort of non-tariff barriers which impede the trade on the continent, because in terms of harmonization of all the rules, it's important as Africa becomes a seamless continent where trade is easier to achieve. We have also provided grant funding to the Secretariat so that it can be efficient in delivering its mandate. And there's a lot of advisory work that will continue to be done by the bank to make sure that this Secretariat is efficient. Then there was an earlier comment that I thought was not answered, which was inquiring as to what we are doing to support confirming banks like. And there were 2 banks in particular that were mentioned in that question, and that was EcoBank and Standard Bank. So through the instrument that I earlier on alluded to, the risk participation agreement, we are extending our balance sheet so that we can support a number of these larger banks on the continent that can then provide confirmation capacity. So in terms of examples, I can mention that banks like Afreximbank have benefited from that facility, that guarantee for the facility. We've got EcoBank, which is actually on the panel, which has also benefited. There are others, First Rand Bank in South Africa, ABSA as well. In North Africa, we're looking at institutions like your Atijari. Then you've got Standard Chartered Bank, who we've worked with, and other banks also on the continent, like your Nedbank, as well as TDB. So we continue to provide that support in order to build up a strong and solid confirming banks on the continent. Then lastly, I think the other point that I thought I would just highlight is, other than just making sure that these confirming banks are strong, we also realize that they might not have appetite to onboard financial institutions in Africa that might be smaller or domestic and state-owned. So what we'll be doing is, in the coming few months, we'll be launching a new instrument that we call a transaction guarantee, which will allow us to identify proactively these institutions which are finding it difficult to get support, and we'll perform our due diligence on them and allocate a line, a credit limit, and then it will become easier for these confirming banks to take a view on these smaller financial institutions when they can provide confirmation capacity. I think, and then the last point perhaps is on AFAWA. I think my colleague Suleiman beat me to it, but this is an initiative of the African Development Bank. It's a 300 million risk-sharing instrument, which is going to be implemented by building on a network of commercial banks and microfinance institutions. And the idea is that women-owned and women-empowered companies would find it easier to access funding from these commercial banks that we'll be partnering with. So the person who asked that question, if they want more information, I think they can reach us. Would be happy to share with them further details and link them with the team in the bank that can provide them the necessary guidance going forward. I think that's the last point that I wanted to make. Back to you.
Thank you, Bleming. And I'll turn to Suleiman, maybe from final thoughts, messages you want to send, given you're the flag bearer of commercial banks.
Thank you very much. I think first, maybe comment just to say that it's going to be important for all of us to continue to push for the implementation of the AFCFTA and basically the agreements in covering the remaining rules, specifically the rules of origin. So we're looking forward and we're pushing, and I think at this stage we are trying to push from an advocacy standpoint so that we get to the promised land, because we feel that with that, you know, some of the trade finance gaps that we've identified would be finally closed by focusing more on the regional or the continental business opportunities. And to just connect that point to that of the supply chain, we've also pushed, and this is under these initiatives that we have with the African Union Development Agency, so that also the public procurements, or, you know, we basically be able to support some of these value chain or supply chain financing by basically formalizing some of the procurement mandates that some of the governments or administrations can give to the SMEs to provide the basis for the financing of those supply chain finance. So these are important points. And I want to just reconfirm the very strong support that we're getting from the African Development Bank, and confirm blaming in the fact that we continuously working hand in hand to basically try to alleviate some of the constraints. And definitely we've had a lot of support from the AfDB with some of the programs that we signed being specifically directed to SME. And we're looking forward to signing very soon a program on the support of SME under the COVID-19 relief program. So great partnership, and this basically leads me to the conclusion, which are basically words of thanks. And a specific thanks to the panel members, but more importantly to those that have spent probably a lot of time digging some of the information and basically delivering this excellent report, which basically provides a lot of insights for commercial banks. And this is on behalf of all the commercial banks, because that would basically give us some pathway in basically being able to circumvent some of the constraints and basically move forward in terms of improving on the development of the continent through trade finance. So thank you very much.
Thank you very much, Suleiman, Gwen, and Bleming. Thank you for your time. And yes, I echo your words. Of course, the thanks is well deserved to the research team of this excellent report. And I also want to thank the audience for their questions and their engagement, which really made all this discussion all the more richer. So thank you all. And I'd like now to turn to Dr. Fofak, and apologies, Dr. Fofak, for running way beyond the time, but thank you for sticking around, and the floor is yours, please.
Thank you very much. And I would also like to join other colleague to thank the organizer of this event. But before that, I think it's important to recognize that we had at opening remark, Mr. Stefan Aletambi, who is actually what I call the umbilical cord between Afreximbank and the African Development Bank, serving as director at the AfDB, but also board member at Afreximbank. And this collaboration is actually something that he is sustaining on a daily basis. I also like to thank the organizer for what I consider as a timely event, which is an important milestone in the commitment to continually sustain the umbilical cord referred to earlier between the two institutions for greater prosperity within the African continent. I am particularly pleased to be part of this official launch of the third editions of this report, and would like to thank the organizer for bringing together the AfDB, Making Finance Work for Africa, EcoBank, and Afreximbank. The third editions of Trade Finance in Africa, a product which has become an important flagship on the continent, highly sought by industry, it's particularly important. And in our view at Afreximbank, this one is actually very special. It is a co-production of the African Development Bank and the African Export-Import Bank, and we are very happy to see the two logos next to each other in the opening page of this report. The previous editions of the Trade Finance in Africa report have provided an update of the trade finance landscape in the regions with one important point estimate. I stressed one important point estimate, the trade financing gap. The first point estimate of that important stat was $120 billion annually in 2011. And according to this report, it's gotten down to 81 billion. To many readers and leaders in the industry, that point estimate has perhaps been the single most important outcome of the report, not the consistently high rejection rate of SME trade finance applications, or less the course or policy option to narrow the trade financing gap that the panel discussed so aptly during these sessions. This third edition is released in the middle of the pandemic, COVID-19 pandemic, which has significantly disrupted trade and trade finance around the world and in Africa. It could actually change the nature of trade finance with the expected shift, in fact, I should say accelerations toward trade digital transformations. The pandemic is also likely to significantly increase the trade financing gap established in the third editions of this report. It is limiting access to the forex liquidity required to finance African trade. And foreign exchange liquidity shortages within the region could also encourage global bank to further reduce correspondent banking lines for domestic bank in the continent. As we saw in the report, it is a very important means of financing African trade. Along this line, the International Chamber of Commerce actually estimate that about $5 trillion of trade credit will be needed to enable a rapid recovery from COVID-19, and warn that widening trade financing gap risk hampering the recovery process. Indeed, as more foreign banks exit the African correspondent banking landscape, the gap in trade finance, often described as the lubricants of trade, could become even more important than the level suggested in the report, and with significant implications for recovery prospect in the regions. The region could account, in our view, for a significantly higher share of that expanded global trade financing gap, at least in relative terms, given that it's more constrained in the correspondent banking landscape. In this regard, the new benchmark for the trade financing landscape in Africa prior to COVID-19, 2019, established in the third edition of this report, is very timely and, more importantly, actionable, something we can actually use to make decisions. In particular, you'll be pleased to know that another study has been carried out by Making Finance Work for Africa, the African Development Bank, UNECA, and Afreximbank to assess the potential implication of COVID-19 for the financing of trade in Africa against the benchmark which has just been put forward, what I call the point estimate of trade financing gap in Africa prior to COVID-19 outbreak. The study has engaged several stakeholders from finance industry, regulators, to explore best options to sustain the lubricants of trade within the regions for a speedy recovery post-COVID-19 within the African continent. I would like to take this opportunity to invite all those attending these sessions to the release of the report, which will be produced next month. It will be an opportunity for industry experts and policymakers to get a first-hand assessment of potential impact of COVID-19 on trade finance in Africa. And naturally, how it is impacting trade finance gap just established. One is wondering, the trade financing gap was $81.8 billion. Could it be large in excess of 100 billion in 2020? COVID explain, COVID impact. And what should African leaders, especially regulators, DFI, and commercial bank be doing to keep the lubricant of trade fluid enough for a strong recovery in the context of a major shift toward trade digital transformations? We are moving toward digitalizations. These are some of the issues we will be addressing during that event, jointly organized by Making Finance Work for Africa, the African Development Bank, UNECA, and African Export-Import Bank, Afreximbank. At this point, I would like to invite you, all the participants, to join me in thanking the lead speaker for a comprehensive overview of the report, and our impressive panel, how impressive were they, for their insight and review of innovative product developed by the respective institutions to expand the financing of African trade, including digital payment, factoring, cost-effective KYC, insurance, to name just a few. And finally, I would like to thank you for your attention. And once again, the organizer of this event for a wonderful event and very timely and for a very rich report. Thank you.
Thank you very much, Dr. Fofak, for these concluding remarks. And certainly we at Making Finance will hail to your call for this upcoming publication. It is very clear that we need to think about the actual situation with trade and the financing of it. Yes, over the years, institutions like African Development Bank and Afreximbank have played a very, very instrumental role in closing the trade finance gap in Africa. Now with COVID, more is needed with the kind of disruptions we're seeing in supply chains globally. And that Making Finance will certainly continue to improve our understanding of these market dynamics and hopefully implement activities that are geared towards closing this trade finance gap in Africa. So really on this note, I want to thank you, Dr. Fofak, for once again. And also I forgot to thank Eugene for his insightful presentation, and also Lola for moderating the panel. And most importantly, I want to thank the audience for their questions and their engagement. So in the end, yeah, please stay tuned. Just a reminder to stay tuned for other webinars we're covering at Making Finance in areas related to digitalization of agri-finance. And we're also looking at the role of financial sector in climate change. These webinars are happening in the next couple of weeks. For now, thank you all again for your time, and stay safe and stay well, and goodbye.